Hey everyone, Daniel Snyder from Seeking Alpha. Thank you for taking the time to check out this webinar today. We are diving into the world of gold and silver with none other than Don Durrett, who has been running on, well, he's been writing for Seeking Alpha for years and years and years. But today we're going to dive deeper into this because there's so much going on between weakening macroeconomic data, central banks buying gold, the ETFs being leveraged in that as well. But before we dive into the conversation today, let's go ahead and get our quick legal disclaimer out of the way. Past performance is no guarantee of future results. Any views or opinions expressed in the webinar do not reflect those of Seeking Alpha as a whole. Seeking Alpha does not take account of your objectives or your financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed security dealer, broker, U.S. investment advisor, or investment bank. Information provided by the investing group does not constitute investing advice. Investing group leaders are third-party authors that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Any content and tools on the platform are offered for information purposes only. All right. Now, with that out of the way, I would like to go ahead and ask Don to join us here on screen because he's the guy that you all came to see here today. So Don, I want to kick things off first. Welcome. Thank you for giving us the time today. I know your time is very valuable. You got quite the portfolio that must be doing extremely well right now this year specifically, even the last few years, right? If we look at 3-year returns of gold and silver, which I just pulled up on Seeking Alpha, it's doing really, really well. So wanted to see if we could kick things off with you by just kind of getting your background. How did you get into investing? How did you get into the gold, silver, and commodity space over focusing so much on like technology growth stocks, which is kind of where everybody goes to nowadays?
Well, I guess I have to be honest, tell the truth. I read a book in 1989 and it basically shifted me dramatically. I became a gold bug in 1989 based on a book that I read. Um, my first stock I ever bought was a gold mutual fund, 1991, and that's all I've been buying ever since. And the reason why is because I've I basically I was kind of ahead of George Bush. No, I guess, yeah, I guess I was because he said it. Was it 88? Well, George Bush Sr. called Reagan's economics voodoo economics, and everybody kind of laughed at him. But I actually was right there with him. I agreed 100%. I didn't believe that the U.S. could go down this path of relying on debt for economic growth. And it's kind of a slippery slope. Once you start down that path, there's just bad things are going to happen. And I've always believed it 100% that I was right. And now it's becoming pretty obvious that I was right. You can see the U.S. government has a $2 trillion deficit and they can't seem to figure out how to fix it. And it's just getting worse and worse, and it's spiraling out of control. A lot of people call it a debt bubble or a debt crisis. But this is the reason why I got into it. 1989, believe it or not. I started buying juniors in 2004 with the idea of a once in a lifetime trade. This was never in, this, First of all, investing, there's no such thing as investing in gold and silver miners. They're not investments, they're speculations. And the reason why is because gold and silver miners are a strange business. First of all, they don't have customers, they have buyers. They get the gold out of the ground and they find somebody who wants to buy it. They have no competition. Barrick and Newmont do not compete against each other. There's no competition. It's a weird business. Plus, when they find the gold in the ground, once the gold's gone, they got to go find another mine, and it's hard to find big mines. It's a terrible business. It relies on the price of gold and silver, which are volatile, which take these very, very long cycles. Like we've been waiting since 2011 for this cycle to start again, 14-year wait. So it's a terrible, it's not you're not investing, you're speculating. But when you get it right, you make unbelievable amount of money in a short period of time. And so for me, it was always about that. It was always about waiting for that outcome. And I call myself a collector of stocks. I'm not an investor, I'm a speculator, but I collect them. Whenever I find a stock I like, I buy it. I've just been collecting them. I have 168 individual gold and silver mining stocks, and then another 9 ETFs, or 6 ETFs, 3 mutual funds. And so I just keep collecting, collecting, collecting. for the final outcome, which we're almost there. So I plan to sell to the top. I plan to be completely out of gold and silver mining stocks by the end of the decade, possibly in 28, but 28, 29, 30, I'll be completely out. So this is a one-time trade for me, but I've been doing it for 20 years, so I'm kind of an expert at it. I figured out how to analyze these companies. I've done really well. Got a really big following on Twitter because people are like, Don knows what the hell he's talking about.
Now, this is where it gets interesting though, because we had this conversation as we were planning this webinar, and you're talking about calling the top of this gold bull market, which you, as mentioned, throughout the entire 2010s, pretty much have been waiting when gold was just in a consolidation range, and now we're in this movement that's unprecedented, for at least from what I've seen in my recent lifetime of being in the stock market. But you said 2028. Why 2028? Or why by the end of the decade is it going to be time for you to completely liquidate and maybe sit on your hands for a little bit?
So this it always goes in cycles, and so the last cycle was 71 to 80, which is about 9 years, and then the cycle after that was about 2001, 2002 to 2011. So you're basically looking at a 10 or 9 or 10 year cycle. So I believe this started in 2019. If you go back and look, some people say the bottom was 2016, but I don't consider the bull market the bottom. I consider it the breakout. So if you look in 2019, that is when gold started trending up. So I think that's when it began. And so, oh, he's going to bring it up. You can show where it kind of broke out in 2019. Yeah, if you break that out a little bit, you'll be able to see. You see what's flat, really, they're real flat there in 2018. Yeah, so right there, that's when it took off. And so that's when I believe the bull market began. You got it. You nailed it right there. May, June
So
of
why
2019.
2019? Like, was there a catalyst in that moment that led to the switch and just the because I mean from if somebody's looking at it from a technical analysis standpoint, you kind of the top
Yeah, I think,
here say like,
yeah, I
oh, is it
it's
really
a
breakout yet? I don't
yeah,
know.
there was, yeah, I think there was a catalyst. And that catalyst was the US economy not being able to basically exist on its own, because that's when you had Powell basically lower rates and then raise rates. It was like he tried to raise rates and he immediately had to lower them. And then that's when everything started to break, if you will. And then we got COVID in 2020. But you could say that the economy was starting to break. We probably could have had a recession in 2019. The economy was starting. It's all about uncertainty. That's what gold basically chases. You do not need gold. Like, I mean, if you look in the 1990s, I mean, look at that chart. You go left, you see that chart, the 1990s, right? Just flat as a pancake, $250 gold. Nobody cared about gold in the 1990s because the economy was strong. And we were 250 bucks in 2000. And here we are at $3,700. What does that tell you? It tells you something definitely broke, something definitely changed. For gold to go from $250 to 3,700, or actually 3,800, $3,800, something changed, something fundamentally changed. And what fundamentally changed is this: the world is based on basically the US dollar and US Treasury. The global standard is the US dollar, and the US Treasury is what countries use as their reserves. Now, just recently, they put those on their balance sheet, US debt. Well, guess what? That debt has always been kind of safe, risk-free. We're going to get paid back so we can hold these reserves. That's changing. Those bonds are no longer risk-free. That's the fundamental shift. And what I've been saying is that this is the debt bubble, basically. Basically, what it comes down to is Triffin's dilemma. So Triffin was a European economist, and he wrote a paper in the 1960s, and he basically said the U.S. is screwed. They're screwed. They have no idea what the mess that they've created by using the reserve currency. This was before globalism actually began. He wrote this in the 60s, and he basically said exactly what's going to happen. He basically said was the U.S. economy would get hollowed out our strength, our middle class, basically the foundation of America, the strength of America was our kind of our middle class. He wrote and he said, "You guys are screwed. You're going to destroy your middle class by having the reserve currency because you're not going to be able to compete against the rest of the world because your currency is going to be too strong because it's the reserve currency." And he was right. And so but it didn't start until the 1980s. But he was 20 years ahead of his time, but he predicted what happened to America, which is basically this big debt bubble that happens if you have the reserve currency. This is why China doesn't want any part of being the world's reserve currency. China doesn't have a free floating currency because if they had one, it might become, they don't want to be the reserve currency. So that's why they won't free float. They're like, we don't want any part of that. We know Triffin's dilemma. We understand that. And so it makes no sense. So that's why no one's going to replace the dollar as a reserve currency. You basically have a hodgepodge is what's going to happen. But the U.S. is kind of screwed here. And now the U.S. economy has been based on debt since 1980. We literally live on debt. Our GDP, so starting in 2000, GDP started going up average 4%. Debt went up 8%. And it's averaged that for 25 years. And so we've been living on debt. And Triffin basically said, yeah, good luck with that. You guys are, there's no way. And then you bring in von Mises. Von Mises in the 50s wrote a paper and basically said that governments that rely on debt to generate GDP, inevitably, you're going to get a debt problem where you're going to get a debt bubble that's eventually going to pop. In other words, von Mises said that you have to pay that back. There's no free lunch. And we haven't paid it back. We just keep extending. And von Mises said, you guys, you do that and it's going to blow up in your face. So that's why I invest in gold and silver mining stocks, because gold is really the only asset that you can kind of run to. It's the only safe place to hide, if you will. And silver as well, because silver turns into a monetary metal because people can't afford gold. But at a certain point, when the fiat systems, which we're seeing today, when they all start to blow up, only place to hide is gold. And the killer of debt is inflation, which was unleashed with COVID. And now there's no putting that genie back in the bottle. And the reason why gold's been ripping here in August and September is because the last shoe to drop is basically you have a problem between the economy. It's basically stagflation. The economy going into a recession and inflation is still sticking around, which is stagflation. And stagflation is the worst of the worst. And so right now, Powell, in early August, the U.S. government came up with revisions for the labor. And labor is the last shoe to drop before you have a recession. Some people call it what's a lagging indicator. It's not a lagging indicator because when it happens, it's over. So labor is starting to weaken significantly in the U.S., that means we're going into recession here if you don't turn it around. And Powell basically said, uh-oh, I got to start paying attention to the economy. I can no longer focus on inflation. So the Jackson Hole speech, that was like the trigger for gold and silver to rip higher, because now you can't fight inflation and fight a weak economy at the same time. You have to choose which one you're going to fight. And Powell actually said that. He said that, the obvious out loud. He goes, I can't do both. And so this is we're in an in-game scenario, but the thing that's nasty, and I don't know if nasty is the right word, unsettling, is that we are in an era, if you will, an epic era where everything changes. This is kind of paradigm shift territory. This is reset territory. And I've been saying that when this recession begins in the US, we will not recover from it. Once this recession starts, what's coming next is kind of out the window. We don't know what's coming next. There's going to be some type of a reset, some type of a financial reset. There's a good chance the US dollar won't even exist by the end of the decade, not in its current form. And so I think when that happens, that basically that reset happens, it'll basically cause kind of instant inflation because when they reset, they'll have to, you know, default on some of the debt, and then the dollar, they'll create some type of a new dollar, and that dollar will be, devalued lower so the US can compete against the rest of the world. And then they'll dump that dollar as the reserve currency. They might even orphan the US dollar internationally, just create a new internal US dollar. And then the other dollars, like, have fun, they're yours. Because right now, the United States does not control external dollars. Like all those euro dollars that exist around the world, those have nothing to do with the United States. And there's more of those than there are in the United States, which is mind blowing. And so that's a problem that we have to resolve, and that's going to be part of the reset.
Don, I want to ask you, 'cause this feels very heavy, right? For me and the audience that I'm sure here is watching us right now and maybe watching the replay. Isn't this also kind of the whole idea of cryptocurrencies and what you're talking about getting rid of the dollar? I mean, we've seen some of that movement already from this administration as they're looking to the whole stable coin space and having it backed by US treasuries. Is all that kind of being factored into you as well? Like, could you see that transition happening from US dollars and I mean not only euro dollar, but the petrodollar, right? Like the oil backing and being that reserve
Yeah,
currency, just
yeah.
transitioning
So
to a
I'm
stable coin, for example.
right. So I've always been a bit of a visionary. And so for me, when I took a look at Bitcoin in 2016, I don't know if in shock is the right word, but I was amazed at what I found. I did basically an all-day dive on it. And I mean, I spent hours and hours just seeing how they solved the general's dilemma, the problem, how they solved the double spend problem. And the way that they did it was just so, it was basically an invention, a software invention. And the combination of basically the elegance of the code, the fact that you can't turn it off, the fact that you can't change the code without 51% agreeing, makes it so potent that in 2016, I'm like, I basically immediately had to buy it because look, I'm like, okay, Don, look, if it survives, and there's no way to turn the damn thing off, if it survives, then it has this halving every 4 years that pushes the price higher and higher and higher. It's basically a collectible. You can think of it as like a Babe Ruth baseball, signed baseball, or Wayne Gretzky signed, rookie card, and you can basically digitize it into a million owners and basically monetize it as a stock, and you can own part of a Wayne Gretzky card, but you can proof of ownership. That's kind of what Bitcoin is. It's like they basically digitize it and split it into 21 million of them, but the Satoshis goes even gazillion Satoshis, right? But you can prove ownership of it. So I can prove ownership of a collectible, but this particular collectible is priced. It's like having a Wayne Gretzky card, but it's priced 24/7 and it's liquid. So I mean, that's kind of how I look at it. Look at it as a kind of a collectible. It's like, okay, I own part of it. Now, what makes a Wayne Gretzky card worth something? What makes it worth something is supply and demand. That's all. People will go, well, Wayne Gretzky was a good hockey player. I want to own his card, and I'll pay for it, right? That's the value. The value is supply demand. And supply demand, every single day, a Wayne Gretzky card either goes up in value or down in value based on supply demand. And so it's kind of very similar to Bitcoin. It's just supply demand, 24/7 valuation. And if you have more people that want it that don't want it, it goes up. And the way that Satoshi made it go up is this halving. Every 4 years, the supply cuts in half. And so, good luck trying to fight that. Now, at a certain point, so I became basically crypto. I'm one of the few kind of gold bugs that basically say you should own Bitcoin too. And then this is kind of interesting, but I actually stopped liking Bitcoin when Bitcoin was at $1,000. That's kind of mind blowing. So 2016, Bitcoin was 400. I liked it at 400. 1,000, I didn't like it so much anymore. So in hindsight, that was a mistake. I should have kept buying it at 1,000, 2,000, 3,000. I should have kept buying it in hindsight. But what I did was I recognized early that Bitcoin had limitations. It's a first generation blockchain. First generation, it can't really evolve. It's kind of stuck. It's really stuck. I mean, the only thing it can really do is act as a collectible, which is basically value is supply source of supply source of value, um, or it can act as some type of utility, which would be like as collateral. And I think that'll keep the value of Bitcoin up. But what Bitcoin invented was the blockchain, and the blockchain has unbelievable potential. So I started investing in the alts, and an alt is any crypto that's not Bitcoin. And for instance, I like Ethereum, and Ethereum has been really good to me. And Ethereum is very dynamic. It's constantly evolving. It's not, it doesn't have these limitations that Bitcoin has. And then Ethereum has tons of competition and all that competition. So these are development platforms. These are software applications. So Bitcoin is a collectible. All these alts are literally Microsoft's. This is basically a software platform. Where Ethereum gets value is people build on top of it. They build on top of it and they use the token, and the token goes up in value. So that to me is what has value. So I've been focusing on these alts since Bitcoin was at $1,000. And so
So
I'm always
Don, just to
looking for the
jump in real
best
quick, so
alt.
you're saying crypto with gold and silver. Is that still what you're claiming at this moment?
There's only four assets to own, I believe, today: gold, silver, Bitcoin, and Ethereum. Those
Okay.
four. You should own those four assets because those are the four assets that are going to do well for the next 5 years.
Okay, well, let's dive in
Like
back to the gold side of things and the gold and the silver. Specifically around, how do you find these gold and silver stocks that you like to invest in? And then how do you value them?
Yeah, that's great. So we can actually, this is a webinar, so let's teach people a few things. But before I bring up on how to do it, I'll give more of an overview of, kind of what you're looking for, if you will. In a bull market, you want elasticity. Elasticity means that when the gold and silver prices go up, your miners go up. You want them highly elastic. Gold goes up $100, you want your stock to go up more in a percentage wise, more than that. You want your stocks to participate in a big way. So, in that regard, the stocks that are going to participate the most are the producers. The reason why is because the producers are going to benefit in a variety of ways. The first way is just the price. As the price of gold's up, their free cash flow will go higher. And as the free cash flow goes higher, their stock will go up. And then as their free cash flow goes up, their balance sheet will improve. As their balance sheet improves, their multiple will improve. So let's say a company has, I don't use PEs, I use free cash flow multiples. So let's say that we have a free cash flow of 5. So that would mean, let's say the free cash flow is 100 million. That means the market cap would be times 5 of that would be 500 million. Now, if that multiple doubles to 10, they go to $1 billion valuation and nothing else happened. It was just the only thing that pushed it up was sentiment. People wanted to own the stock. You hear about, the PE multiples expansion, right? So you get that. So producers are going to benefit from as the price goes up, better free cash flow, better balance sheet. Then the other way that they can benefit, as their balance sheet improves and they have all that cash in their balance sheet, they can use that to drill existing projects, buy new projects, build new mines. So they have all of these levers, if you will, to grow the company. So producers have huge elasticity. I think I'm going to make 80% of my returns on producers. The second one that has huge elasticity is developers, who investors think are going to benefit from future free cash flow. So when investors say, okay, this particular project, when it gets built, is going to be worth a fortune if gold prices maintain where they're at. So you want quality developers. Those are the two groups. As a matter of fact, on my website, I have a favorites list with 83 names. There's only one exploration stock on there. 82 of them are either producers, near-term producers, or developers. Only one exploration. And that one exploration company is unique. It's unique in the fact that it's an optionality play where insiders own 50% of the stocks and they're not selling. They're waiting for a big return. So it's a unique. So optionality plays are okay. So those are kind of the three groups you want to look for. Now I'm going to show you how to find them. I mean, how to analyze them, excuse me. I'm going to share my screen and I'm going to show you how to analyze these stocks. So the first thing we're going to start with is producers. Now I have to go fast because if I went slow, this webinar will be over. So the first one is your producers. So what I do is I use rules, and my rules are they got to pass this checklist. So the first thing you're going to do is you're going to look at the properties and you're going to make sure that it basically kind of passes. It's kind of a quality. So you can rank these like them from 1 to 10, and you're looking for problems. And so the better the quality properties, the better. Then the next one is location issues, then financing issues, if any, management team, the valuation. So this is basically your upside. And then the balance sheet. By the way, you can read my book and get a better understanding on how to analyze each data point here. My book's kind of a textbook on how to do this stuff. 6 is a balance sheet. 7 is the margins and the cost. 8 is exploration, the pipeline. 9 is share structure, share dilution. And then 10 is the overall risk reward. So you're trying to find one that basically has everything, has these 10. I have chapter 10 of my book goes over this stuff. And if you can find a producer that basically checks all these boxes, you've identified an edge. You have an edge. Only thing that you really need is the gold price to go higher. And what we're trying to do here is we're trying to get an edge. We're trying to find really high quality potential stocks. You're not trying to pick winners. You're trying to pick potential winners. People always say, tell me the best 5. You don't know which one's going to be the best. I always tell this story about this one stock that I bought. I had no idea. You have no idea what they're going to do, who's going to buy them, what projects they're going to acquire, what they're going to discover. Your big winners are always going to be surprises. So don't try to pick winners, just try to get quality potential winners. Okay, so that's producers. Checklist. Now we do developers. So strong project, and this is similar to the properties, but you're looking for a specific project here on a developer, just one strong project. And then high upside potential, you want it to be at least a 10 bagger. You want to have room for error because these will disappoint you. You don't want a developer that prints as a 5 bagger. That's just not enough juice. You want some significant juice because things can go wrong, and they usually do. And on the high upside, I'm an unusual investor in that I project out into the future. Currently I use $5,000 gold and $100 silver. And I actually think those are conservative right now. I think they both need to be pushed up a little bit. Good location. Location is very important. Strong management team. Well, all 6 are important. You need all 6. Strong management team. They need to have experience, a good team, a good board. A path to production. This is usually what's missing. You want a company that has a really strong plan and they're telling you exactly what they're going to do. I get really comfortable when I see a strong management team. When I get all 6, I can't. One thing doesn't work. You need all 6. But when they give you a really strong path to production, that gets me excited. And then you got to have strong insiders. Sometimes I'll gamble. If they don't have all 6, you're gambling. And so once in a while I'll gamble on one. But I don't really like to, if they don't have strong insiders, the chances are they're going to get acquired or they're going to sell, which is kind of the same thing. Now, the next one is the exploration. And this is the one where people are making a big mistake today. Remember I said earlier that you need elasticity. Exploration stocks do not have elasticity. If you have an explorer that makes a discovery, nobody cares about the gold price or the silver price. What they care about is the next drill hole. And that's why people love them, because they're not elastic. And so exploration stocks, they always work. They work in a bear market, they work in a bull market. But in a bull market, you have better risk reward in producers and in developers. You don't need to mess around with explorers. But if you can use my 2 rules for exploration at any time, because if you use these rules, you're basically going to get an edge. And that's what you want as an investor. The first one, there's two rules. Rule number one is optionality plays. And this is where you only want to buy explorers if they follows one of these two rules. Rule number one is if you can find an exploration stock that has gold or silver in the ground that's highly undervalued, and it's kind of a significant amount, you don't really want to do an optionality plan on 1 million ounce gold deposit. But 1.5 million and above, it can work. So let's say you have one that's 1.5 million ounces. Now, if it was at $100 an ounce, it'd be valued at $150. But if it's at $10 an ounce, it'd be valued at 15 million. So if you find one at 15 million or less, that would be a good optionality play. And there's several of them today. I've done videos on optionality plays that I like. The thing that's nice about optionality plays is it's like free money. Because eventually that value, that gold or silver in the ground is going to get valued higher. A good example is like Banyan. Banyan gold was valued at $8 an ounce, like, I don't know, a month or two ago. Today it's valued at 32. So if you would have bought it at $8, there's like no way you're going to lose money. It's just a matter of how much money you're going to make. So a lot of these optionality plays is like printing money. Okay, rule number two, and I'll be done here, is the Lassonde curve. And what the Lassonde curve tried to teach people, and everybody ignores it, is that the best time to buy an exploration play is at the very beginning of the discovery. So that's early in the Lassonde curve. And all you have, the Lassonde curve basically is the share price. And so the share price initially is very low, so they haven't made a discovery. And then they make an initial discovery. That's when you buy it. And it's early in the Lassonde curve. And then you just follow it up the Lassonde curve. The way the Lassonde curve is like a mountain. So you climb up to the mountain and then you go down. So you want to sell when you get to the top of the mountain or close to the top of the mountain. And the only time you want to buy is you have it, you're early in the Lassonde curve and you have an excellent drill hole. This is the one thing people miss. So this column here that I'm highlighting is the excellent. So if a company makes a discovery of anything like gram meter over 200 and it's early in the Lassonde curve, you can chase that one. Or silver more than 2,000. And if you find one with a stellar hole, those are the ones you really want to jump, or if it's close to stellar. And those are the stocks that have the inelasticity that work. So if you follow my rules, and so I have one caveat, the gold silver price is really important. So even if you follow these rules, we're still betting on the gold silver price.
Yeah, thank you for walking us through that framework. That definitely opens up a lot of questions for me. I know there's a lot of questions coming in the chat, and hopefully we'll get into those in just a little bit. But one that came in just a moment ago, maybe we can go ahead and touch on, because I thought it was a good idea, and I pulled it up here on Seeking Alpha, is people go, well, how do you find the stock in the first place? To which I was like, well, I know we have the screener here on site that if people want to go down to top material stocks, I mean, it's a list of gold stocks right now and mining stocks and the things like that. So is this a similar way that you find tickers?
I'm actually laughing. Can I share my screen again?
Okay.
Yeah, I just want to show you guys how powerful my database is. You say, how do you find them? Well, here, I'm going to show you. So I have 850 stocks in my database. This is my search and compare. This is my search engine. So let's say we want to find all the mid tiers in the world. All I do, if I want to find the silver or gold ones, I can do either one. So let's say I want to find all the gold I can do both, but I'm going to filter it to gold. So these are all the gold. Wait a minute, I got a search engine up here. These are all the gold mid tiers in the world. I click on that button, boom, there they are. There's 35. So if you want to find them, that's how you find them.
Okay, so you're using this, you're pulling these stocks together, and then you're diving in. And just to reiterate, I mean, you got quite a list there, but for people that are newer to this sector and this arena, I mean, are there certain valuation metrics, growth metrics, profitability metrics, things like that you look at specifically?
Yeah. So the thing is beautiful is, so when I started doing this in 2004, there was no books on the subject. So I wrote my own. There's no website. So I created my own.
Which, can I mention real quick, your book, if anybody wants to look it up, How to Invest in Gold and Silver is the title of it. And of course, everybody just look at Don. I believe it's on Amazon is what I've seen. So sorry to interrupt, but I just want to make sure we got that in there.
Yeah, real easy to find on Amazon. So the website, I created for people, like you said, how do you find these things? So that was the one thing that drove me nuts when I started. I couldn't find anything. All right. It was almost impossible. Back then, 2004, I mean, the internet was there, but try to find all the mid-tier producers. I mean, it was impossible. But now I created that search engine and basically, okay, here they go. So now you get a list of all of them. Now, how do you find the good ones? You read my book, and my book will explain what to look for. All the goods and the good, bad, and ugly of each company. And so I've laid it out for you between my website and my book. I wish I could say that there was alternatives out there. There isn't any. The one thing you got going for you is AI. So you could use AI, and that will help you significantly. You could say, okay, I don't really have the money to join Don's website. It's not super expensive, $199, although prices probably will rise. Um, but you can go to AI and say, give me all the mid-tier producers, and it'll give you a pretty decent list. But then once you get that list, what do you do with it? You still have to know, how do I analyze these stocks? So that's where my book comes into play. Now, you can also ask AI, how do I analyze these stocks? But trust me, my book is going to be very useful in that regard.
Now, as I mentioned, we talked before this webinar. You at one point had mentioned the importance of free cash flow, specifically for these companies. Would you mind diving into that a little bit and why it matters so much for the gold space and silver space as well?
Yeah, so this is a cash business. So you constantly have to reinvest. You have, if you're a producer, you have sustaining capital. So if you're not generating a profit, you're in trouble because you have that sustaining capital to keep ongoing monthly sustaining to keep your business running. In other words, it doesn't run for free. And so you have basically what are called margins. So your free cash flow is your margin. Now, until about, I don't know, a year and a half ago, margins were not that high. Now margins are very high for gold miners. And they finally, in August, they finally got high enough for the silver miners. But the silver miners have been struggling because their margins were so low and they didn't have enough free cash flow, to basically make any money. And so not only do you have sustaining capital, but you also have to spend money on future exploration to replace your reserves. So you have the cost of sustaining capital and the cost of exploration, and then you have the G&A, of course. So you need to have margins, and some companies have debt on their balance sheet, which they have to service. And so it's basically it's a highly cash business because you're constantly having to spend money, if you will, to stay in business. And so the more free cash flow you have, the higher the margins you have, you can start cleaning up your balance sheet. So, for instance, if you look at all the majors today, there might be one like Lundin that has no debt, but most of them have significant. There you go. I mean, you look at their debt. If you're looking at Newmont there, they have like $6 billion in debt, and we need to get that balance sheet cleaned up. So, if we look at long-term debt, so current long-term debt 1.9 billion, and then long-term debt 7.5 billion. That was in 24. So it's down. So they have massive debt, massive, and all the majors do. And the reason why is because we haven't had high margins until recently. And so it's going to take them, probably 2 years to clean up these balance sheets. And as they clean them up, their multiples will start expanding. I actually think that Newmont's multiple will go from a 10 to 25. So you're basically buying Newmont today at less than half off if you buy it. My target price for Newmont is $300. I think it's about 80. Okay, it's at 86. I said it was going to go to 300 when it was at 30. And people are like, no way, Newmont's going to be a nine-bagger? And I'm going, yeah, it is. And so here we're at 86. You wait, well, next year we'll be at 150, and all you need is a one-bagger to get to 300.
So
So
is
yeah,
the goal though for 300 by the year 2028, or is it end of the
yes,
decade by 2028?
yes, at $5,000 gold, it could happen in 27. 27 or 28 is kind of my target for $300 gold for Newmont.
Interesting. What's another? I mean, we talked about Newmont here, but like, what's maybe one of the undercover ones that we could look into real quick? Whether it's a gold miner, a silver miner, one that
Well,
you liked recently.
I've said this publicly many times. So when we just got back from Beaver Creek, and I'll tell you my top three stocks at Beaver Creek, and let's bring up a chart. The first one was 1911 gold, And people are really apprehensive of 1911 because the previous mine went bankrupt. It was Sandgold. But what people don't realize is that the only reason why Sandgold went bankrupt is because the price of gold dropped. That mine would still be in business today if gold would have been high. They didn't have a cost problem per se. They had a gold price problem. And so now you're at $3,800 gold. It's not going to be that difficult for them to restart this mine. And I've always loved this story. And basically nobody wanted to touch it. I mean, you look at that chart, nobody wanted to touch it until recently because now this company will be back in production in 27. And so next year, 26 is all about prepping. I think Q1 and 27 will be back in production. It's in Canada, which is beautiful. It's very cheap. I mean, you look at the market cap. So 200 million for a Canadian producer. My target price for this one's $10. So that's one. So that they're a near term, not quite a near term producer yet, but they'll be a near term producer, in about 6 months. It'd be about a year out. I consider a near term producer within 1 year. But they check all the boxes the way that you remember I showed you my development checklist. These guys definitely check all the boxes. The next one you can bring up is Talisker Resources. So one thing I like is location. So 1911's in Manitoba. The next one's Talisker, and they're in British Columbia, another Canadian play. And both of these, they actually have a bigger mine than 1911. They're going to be producing. They're producing right now, I think, about 15,000 ounces, and they're going to be producing 50,000 next year. And you can see this one was at 25 cents, and now it's up to $1. And it's still these stocks have come up, but they're really, really cheap still, believe it or not. I mean, like I said, I got $10 target, for 1911. It's trading at what, 75 cents US. Same with Talisker. Talisker has the same potential upside as 1911. They're actually a bigger mine than 1911. 1911 is about, I think, 1.5 million ounces. And this one's more 3 million. They're going to be mining 50,000 in 26, and then 90,000 to 100,000 in 27. And then they're going to build their own mill. So the first 2 years, they're going to be using toll milling. Then they're going to build their own mill, and they're probably going to grow to 150,000 ounces. Now, 1911 has strong insiders. Talisker has a bit of a red flag. They don't have high insiders. So I think they could get taken out, that which concerns me. If I was a company, like if I was Artemis Gold, I'd be taking these guys out. Anybody that's in the neighborhood. Yeah, so their insiders are a little bit weak there at Talisker. So that's the risk there. Now, the third company, I said I was going to mention three, was Jaguar Mining. Jaguar Mine, let's bring up its chart. It's actually a very cheap producer. They have 3 mills at 2,000 tons each. So it's starting to trend up. And only one of them is being used. And the other one, it's only been half. So out of the 6,000, only 1,000 tons is currently being used. And they're going to fill up all 6,000 tons per day. So they're going to go from 40,000 ounces to 150 to 200, probably, let's say 175 to 200,000 ounces a year. So they have this huge growth ahead of them. Plus, that's just on their existing mines. And the new CEO, who I really like, is very aggressive. He basically has a plan on how to basically fill up those mills. And trust me, this guy's he'll pull it off. So those are the 3 mines, the 3 stocks that I walked away from Beaver Creek saying, I got to buy these ASAP kind of thing. Well, yeah.
Jaguar here with 50% ownership, as I know you were mentioning.
Yeah, it's beautiful. Yeah, it's absolutely beautiful. That's all Eric Sprott. Eric Sprott owns half the company.
So he's got it in his best interest. Thank you, Don, for providing these names. This is insightful for us.
Sure.
I wanted to see if we could go ahead and transition. There's been a lot of questions coming into the chat, and I just want to take the duration of our time that we have left with you today. There's one big question that's been coming up time and time again, and what is the difference between explorers and developers and producers or miners? Like, can you kind of categorize those for the people watching?
Well, I already did on a risk reward basis, right? I said the producers have the best, developers have the second best. And explorers, not so good in a bull market. You can kind of avoid them except for those two rules. You want to keep your developers in a very small little group. I have about 8% in my portfolio, and I feel like I have too much, but that 8% is mainly optionality plays. But and I kind of went over this a little bit. I talked a little bit about how producers, it's all about margins, free cash flow, and it's about how you grow the business. Um, we always, as a producer, I always want an aggressive management team. I want them to always be thinking about how do we grow production. It's the growth companies where we make baggers, if you will. We don't want companies to just sit there and mine 100,000 ounces. Like Jaguar Mining, I mean, they were content to mine, 60,000, 70,000 ounces just year after year, just plod along. And now they have a new CEO, and he goes, "Oh, I'm not content at all at that. I'm off to the races here, people." And all it took was a new management team. The one thing I found in this business that good management teams are actually pretty rare. I mean, even the good companies do not have good management teams, believe it or not. I mean, I couldn't get people to buy. I created a group called the Mormons, which were the 8 prettiest girls in the silver place. I really like all the Mormons because you normally don't marry a stock, but in this instance, you want to marry all 8 of them. So they're called the Mormons. Just marry them all and don't divorce them. And I couldn't get people to buy Heckler and Koch down at $2. They're like, "I'm not buying that piece of crap. It never performs." And I was like, "You're looking at this thing wrong." Heckler and Koch, yeah, their management team, they've never really focused on shareholders, but they do really well in bull markets. Just go back to 2009 to 2011. And then go back earlier. So Heckler and Koch, so people are like, I'm not touching it. But the guys that got in at $2 now, Koch, bring the Koch chart up. Now Koch is at, I think, 18. It's like an 8-bagger since I mentioned it. The
What was the name of
Mormons,
that one?
since I CDE, Core Mining CDE.
I did.
So since I yeah, so you can see when I created it in 23, look at how low it was at $2, and now it's at 18. So how's that for a return? Guess what my target is on this? 70. My exit price on Coeur is $70. So if you would have bought it at 2, it would be a 34 bagger, I think. So 30 bagger for Coeur, a high quality silver producer, believe it or not. If we get to $100 silver, but people wouldn't buy Heckler and Koch. I'm not touching those because of management. They're like, "I'm not going to do it." So it's, I can mention a few other companies that, people won't touch because of management. So you're always trying to find that elite management team, that quality management team. And I really like them. I call these companies like sharks and I also call them buy and build companies. And I want these companies, as soon as they build a mine, they go buy and build another one. That's what I really want. G Mining is what like that, Orla Mining, Perseus. I mean, these are companies, SSR Mining. They don't mess around. I mean, they just buy and build, or buy an existing mine that it's already in operation. So we want to find these aggressive companies. The thing that really absolutely blows my mind is we have not seen a single, this is unbelievable. We have not seen a single silver development story get taken out. Now we've seen 3 producers. We have MAG got taken out. We got Gatto's taken out. We got Silvercrest taken out because they were all accretive deals, but nobody will overpay. Like, nobody will overpay. Nobody will pay for these development stories. There are 15 quality silver development stories out there that have been out there for 5 years and nobody's touched them. Like, when is there going to be, when are they going to start acquiring these development stories? I mean, these stories like Abra Silver, Go Gold, Vizsla, there's a lot of them, Minorum, Silver One. There's tons of these silver development plays out there. Nobody's buying them. They're like, no. And the reason why, I'm sure there's been offers, but nobody, and even the big Corani, Bear Creek, even some of these exploration companies, nobody's going after them, and they're cheap. I mean, if you look at like Southern Silver, valued at 35 cents an ounce in the ground, and nobody's buying it. It's like nobody believes in the silver price going higher. Now, I do think that once we get above $50 silver, they're gonna go, oh, these are accretive. Okay, now we can buy them. Now we can buy them. But nobody has any vision. When Avino was at 40 cents, 40 cents, I basically said, this is the best buy on the planet. And then bring up Avino, ASM. And I was telling everybody when it was at 40 cents, I said, buy this stock to the bottom. That's my favorite way to do it. Buy it to the bottom. And I always nail these bottoms because they're so obvious to me. Once the stock starts bouncing on the bottom, you know it can't get any lower. This is when it's been a 10 bagger. Coors been a 9 bagger. And these stocks are still cheap. I mean, Avino, and the thing that blew my mind was nobody would buy Avino. None of the Mormons are like, well, I don't want it. I'm like, you have no idea what you're passing up here. And the thing that's crazy is Avino doesn't have any insiders. 80% of the company is owned by retail. 80. So they're sitting duck. If Heckler went in there and said, okay, we want to do a 30% margin premium, the retail crowd would say, sure. The retail crowd would buy it in a heartbeat. There you go, 78% retail. There's no way in heck they could fend off Heckler if Heckler wanted to buy them, or Coor wanted to buy them, or First Majestic wanted to buy them. But they don't care. They're like, oh, it's not accretive enough. It's amazing to me how conservative this sector is. Now, if I was on one of these boards when Avino was at 40 cents, I'd be pointing my finger going, go buy that company right now. It's like, I mean, they're sitting on 350 million ounces of silver equivalent. 350 million ounces. That's why they're still cheap. And it's like, you could have bought that thing for it's unbelievable. 20 cents an ounce on the ground. 20 cents you could have bought Avino if you wanted to back in the day when it was cheap, but nobody would touch it. They're like, no, it's not accretive. Now, okay, so he wanted me to tell the difference. So development stories, I went over producers, development stories, those are highly risky and they'll break your heart over and over again. The reason why they're going to break your heart is because they have high upside. You can find these development stories there's a bunch of them that I own, and a bunch of them are going to break my heart. And the reason why they break your heart and they have high risk is a lot of things can go wrong. You have cost overruns. You have ramp up problems. You have grade issues. You have dilution issues. Management doesn't perform. So many things can go wrong with these developers. I always say that it's an 80-20 rule. Only about 20% of them are going to be your 10 baggers. The other 80 are going to disappoint you. And maybe 30% break even and 50% break your heart. But if you can, if you can find enough of these, I call them home runs, those are 10 plus baggers, then it works. But again, the best risk reward is going to be your producers.
Yeah, thank you so much, Don. I just want to mention real quick, because I know we're getting towards the end here. If you like everything you've heard today, the explanation Don has provided today has been next level to me, especially some of these names I've never even heard of before. I would highly encourage you. He does run gold and silver mining ideas here on Seeking Alpha. You do have a promotion going on as well, where it's $30 for that first month. You get access to all of his analysis articles on Seeking Alpha. You have the active live chat, so you can actually ask him more questions and engage with his community there. Model portfolios, exclusive ideas as well. But also, I want to encourage you to follow him on Seeking Alpha if you haven't already. This is one of the greatest ways to just get these updates that he's been putting out. I mean, that's the easiest way just to stay in Don's circle here. So I just wanted to take a second to mention that. Don, there was a quick question, and actually, sorry, for the team in the back, if you wouldn't mind, go ahead and drop the link in the chat for everybody so they can easily find that. And if you're watching the replay, it'll be beneath this video. But Don, wanted to go back because there was a question about when we talked at the beginning of this webinar here today that you're going to sell in 2028 or towards the end of the decade. As an investor yourself, when you sell, are you going to look to put that money to work elsewhere, or is that just kind of like you're riding off into the sunset at that point?
Yeah, I'm going into retirement. So then at that point, it's just going to be about protecting my capital. So yeah, it's going to be difficult to figure out where to move that money off to figure it out. But I wanted to go back and mention about my mining ideas, my investing group. The best place really to learn about mining, the best bang for your buck is my website, Gold Stock Data. the mining stock idea is just an add-on really for kind of high net wealth people, because what you're getting there is access to me. It's like $500 a year, but what you're getting is access to me in the DMs, which is kind of nice. So you can basically, those guys can DM me and I'm answering their questions. That's the biggest one. But as far as data goes, I do a weekly video. And so I mean, so it's not a ton. I don't write a lot anymore. I don't have time. So I've been doing weekly videos. I do write. When I get time, I'll write up something, but a lot of it is like a weekly video. But the mining stock ideas is you're getting two things: access to me, but the second thing you're getting is a model portfolio. And the model portfolio, I'm I'm basically managing myself. So what I'm doing, that there's like 80 names. It's like it kind of follows um, my favorites list on Gold Stock Data. But the difference is that I actually have a notes section where I do adds and removes. So you can follow me over the next 2 years as that model portfolio goes up and down, if you will. So that's where the value is. And so you can try it for 30 days. The model portfolio, if the model portfolio doesn't fit you, then it makes no sense. You can stop right after 30 days. But if you think that model portfolio kind of fits you to a certain degree, and those are stocks that you want to buy and sell, then it might make sense. But I consider this an add-on to my website.
Now, I got to ask you because as we've been talking about today, gold's on a tear, right? Increased volatility within this sector. Gold historically has had moments of volatility going both ways for various reasons. Do you feel the conviction right now that, this is a very sustainable rally to the upside, or would you be expecting like a cool down pullback anytime within the next few months potentially?
Yeah. So if you ask Grok, tell me the average. No, just tell us. Give me a list of the corrections in gold from 2001 to 2011. Every single year, there was a correction of at least 10% in gold. 10%. Big gold was very volatile from 2001 to 2011. But all it did was every time it went down, it turned around and went back up. You always had 5 to 10% corrections in gold from 2000 to 2011. So up and down, up and down. So you'd have to break that up. It looks like it went straight up. It doesn't look like there's any significant corrections, which is true. But the mining stocks are going to be volatile here going forward. Now, my point was this: is that 2001 to 2011 was a bull market in gold, and that's what we're in now. But that didn't mean you didn't have corrections in mining stocks. We had significant corrections every year. And so, yeah, get ready for it. But if you're in a bull market, it's just a matter of, how long you have to wait it out before you're back up again. So I expect gold to correct somewhere between 8 and 12% when the stock market finally crashes, if you will, because I think the stock market's going to crash because of what I said in my opening comments. So when the stock market crashes, we can expect gold to get, I think, 8 to 12. So that means you can expect your portfolio to go down somewhere between 12 and 20%. That's my expectation. And if it goes, it's going to go down in the teens is my expectation. If your portfolio goes down in the teens, it's really a nothing burger, because if we're in a bull market, we're just going to, that correction will only last about 4 to 6 weeks. 4 to 8 weeks is my expectation, and we'll be back up. So the HUI is a little over 600 today. So let's say it goes all the way back down to 500 or even 480 or even 450, which seems like, oh my God, right? But let's say the worst case, it goes down back to 450. It might be back at 550 within a month. And so it was kind of a nothing burger, right? So that's my expectation, because I lived through that last bull market, and I rode all of those dips, and it was like, just wait. It'll go back up. We're in a bull market. And so I always say, don't try to trade this. Just get on the train and buy the dips and just get ready to withstand any any significant drops. Now, the one thing I've done is I know that a dip's coming because I just know we're going to get one. It's going to happen. So what I've done is I've created a list of 5 or 6 stocks of that I already own, but they're kind of underallocated. They're underallocated. I'd like to add a little more to them. So I'm going to add shares in those 5 or 6 stocks when the dip comes. And I've actually already allocated the funds. It's like the money's just sitting there waiting for I'm sitting there waiting for the dip to happen, kind of thing. And you should do the same thing. But your list might include stocks you don't own. Um, and so, and basically get ready to buy the dip because the dip is coming. I don't think we'll get a 25% correction in our portfolio, but high teens and maybe low 20s is possible. I definitely expect teens. If we only get a 15% correction, well, that is teens, but 12, if we only get a 12% correction, we'll be very lucky. That'll be a nothing burger totally, but I don't think we'll get that lucky. Expect high teens.
All right, Don, let's go ahead and wrap it up there. I just remind everybody too, I mean, corrections of 10% are pretty normal in bull market runs as well. So just because it goes down 10% doesn't mean the bull market's over. But Don, thank you so much for your time and your insights today. This has been highly, highly enlightening for myself and tons of people that have been saying thank you in the chat for you today. If you've been watching the webinar replay, we hope you found something valuable here as well. Make sure you follow Don. Make sure you go check him out, do all the things, check out his book as well. But Don, again, thank you so much. Everyone, thank you for taking the time to join us today. Have a great rest of the week, and we'll see you here in the next webinar. Take care.
Thanks for having me on.